Billions are pouring into AI. Startups with no profits are worth fortunes. Tech CEOs promise a revolution bigger than the internet itself. But we've seen this before. In the late 1990s, Pets.com became the face of a new digital age. The company launched with a simple promise: pet supplies delivered to your door, powered by the internet. Investors rushed in. In February 2000, Pets.com went public, raising $82.5 million in its initial public offering. The market valued the company at nearly $300 million. But behind the hype, the numbers told a different story. Pets.com spent millions on marketing, including a $1.2 million Super Bowl commercial featuring its now famous sock puppet. The mascot showed up everywhere, on television, in parades, and even on late-night talk shows. The brand seemed unstoppable. Yet every sale cost more than it brought in. Customer acquisition averaged $400 per person, while the typical order was only $40. Shipping costs devoured any hope of profit. For most of 2000, gross margins were negative 28% from January to November. By the fall, the cracks were impossible to ignore. In September 2000, Pets.com reported a $42.4 million loss on just $5.2 million in sales. The cash burn accelerated. Employees waited for the next round of layoffs. The share price collapsed from $11 at the initial public offering to just 19 cents. Investors who bought in at the peak lost 99% of their money. On November 7, 2000, Pets.com announced it would shut down and liquidate. 255 employees lost their jobs. The sock puppet, once a symbol of internet optimism, faded into punchline status. Former CEO Julie Wainwright would later call it a great idea at the wrong time, a casualty of unchecked enthusiasm and easy money. Pets.com wasn't alone. Its rise and fall became a cautionary yardstick, a story of how marketing spectacle, easy venture capital, and a rush to go public could inflate a company with no sustainable business underneath. The lessons of Pets.com echo through every wave of tech mania that follows, ready to surface whenever money chases a dream faster than reality can catch up. Money is flooding into artificial intelligence at a speed that dwarfs the wildest days of the dot-com boom. In 2025 alone, AI startups raised over $200 billion worldwide, nearly quadruple the funding levels seen just 4 years earlier. The pace is relentless. Venture capitalists scramble to outbid each other, driven by a fear of missing out that has become the industry's rallying cry. One investor put it bluntly: "We are scrambling to write checks before the next breakthrough lands." The numbers tell the story. More than 53 AI unicorns, startups valued at $1 billion or more, have emerged in just the last 5 years. Yet beneath the surface, nearly a quarter of these billion-dollar companies have yet to generate any revenue at all. 22% are pre-revenue, living on investor cash and promises of future dominance. Valuation to revenue multiples often soar past 30 times, far above what even the most optimistic SaaS companies commanded a decade ago. The gold rush is not limited to startups. Tech giants are pouring hundreds of billions into AI arms races. Microsoft has committed $10 billion to OpenAI and continues to expand its Azure AI infrastructure at breakneck speed. Google's internal AI budget now tops $15 billion a year, with plans to double down by 2026. NVIDIA, the hardware kingpin, has watched its market cap balloon as demand for AI chips explodes, its share price leaping from $160 to $860 in less than 2 years. The branding frenzy is just as intense. Since 2021, 1,140 companies have rebranded themselves with AI in their names. In the final quarter of 2023 alone, nearly half of all rebrands happened as firms rushed to tap into the hype. Data shows that adding AI to a company name more than doubles the odds of reaching unicorn status within a year. The feedback loop is unmistakable: more hype, more funding, more unicorns, often with little to show but a pitch deck and a burn rate. For many venture funds, the logic is simple and dangerous: miss this wave and you might miss the next Google. The result is a market where capital chases ideas at a velocity that leaves due diligence in the dust. The AI gold rush is rewriting the rules of tech finance, but the warning signs are everywhere: valuation bubbles, branding games, and a collective mania that echoes the fevered days of the late 1990s. The question is not whether the boom will end, but how many will be left standing when the tide goes out. Across the AI startup landscape, warning signs are flashing red. The numbers are stark. The median annual recurring revenue sits at $150 million, but the average monthly cash burn, hovers around $30 million. That leaves a runway of barely 5 months before the money runs dry. For dozens of billion-dollar firms, survival depends on raising new capital faster than they can build a business that pays for itself. The pressure isn't just financial. Beneath the surface, a new kind of bottleneck is tightening its grip. The entire industry leans on a fragile backbone of high-performance GPUs, specialized chips that power every major AI breakthrough. In 2021, hyperscale data centers operated about 5,000 GPU racks dedicated to AI workloads. By 2025, that number has exploded to 22,000. But the supply chain remains concentrated in the hands of a few dominant providers. If access to these chips stalls, the growth engine for hundreds of startups could sputter out overnight. Venture capitalists track one metric above all: runway. But in this market, even companies with billion-dollar valuations are living quarter to quarter, often with less than half a year of cash in the bank. Investors pour in money, sometimes at 30 times revenue or more, betting that the next funding round will arrive before the bills come due. The logic echoes the dot-com era, when capital chased vision faster than any business could deliver results. Beneath the branding, the pitch decks, and the promises, the foundation is fragile. The AI boom is propped up by a cycle of speculation, infrastructure dependence, and a race against time. If the market turns or the hardware pipeline falters, many of these high-flying ventures could find themselves with nowhere left to land. OpenAI crossed a milestone in 2024, $1.2 billion in annual revenue. Unlike the dot-com darlings that ran on hope and marketing, OpenAI's business is anchored in real demand. Its language models now drive workflows for banks, law firms, filmmakers, and software giants. Microsoft's $10 billion partnership is not just a press release. It is a pipeline of enterprise contracts, API subscriptions, and Azure integration that generates steady cash flow. NVIDIA stands at the heart of this new economy. The company's share price soared from $160 to $860 in under 2 years, reflecting a global hunger for AI chips. Data centers cannot get enough of the high-performance graphics processing units that power every major AI breakthrough. Cloud providers including Microsoft, Google, and Amazon are spending billions to expand their AI infrastructure, betting that demand for compute capacity will only accelerate. The numbers are staggering. Multi-year capital expenditure plans from hyperscalers now top $100 billion, much of it earmarked for AI workloads. Every month, new data centers come online, packed with racks of NVIDIA hardware. The supply chain is tight, but the payoff is clear. Whoever controls compute controls the future of AI. This investment is not just speculative. Across industries, AI is already delivering measurable gains. In healthcare, diagnostic tools powered by AI help doctors spot cancer and other diseases faster and more accurately. In software development, AI code assistants boost productivity, cutting project timelines by weeks. Studios use generative models to render visual effects in hours instead of days. Factories automate inspection and maintenance, saving millions in downtime. OpenAI, NVIDIA, Microsoft, and Google are not just chasing hype. They're building the backbone of a new digital economy. Their products generate revenue, reduce costs, and solve real problems. Even if the speculative excess burns off, these platforms are positioned to endure, much like the survivors of the first internet crash. The story is not just about who wins the gold rush, but about which technologies will still matter when the dust settles. Speculation once crowned pets.com, now it fuels OpenAI, NVIDIA, Microsoft, and Google. Hype and FOMO inflate fortunes, but beneath the frenzy, real AI transforms industries. The line between bubble and breakthrough blurs. History does not copy itself, but it rhymes, especially when billions are at stake. Share your thoughts below.